Hi, everyone. Joe Andrews here, Chief Investment Officer at Agilis, just with a summary of our monthly macro update for August. So it's still a very challenging year from a macroeconomic perspective. So we're still in this tug of war between weakening global growth and inflation that's frankly just too high. Now, the consequence of that high inflation is as economic conditions are slowing, financial conditions are continuing to tighten. And that's really unusual at this point in the cycle. Normally, you'd expect central bankers to be closer to loosening policy to deal with those weaker economic conditions. But central banks really have no choice but to keep tightening policy until really they have concrete evidence that inflation is confidently heading back to their target. And until we see that, and until bond yields, we think, start pricing some additional stimulus, or at least a slower pace of tightening, we think equity and credit markets are going to remain under quite a bit of pressure, particularly given economic conditions we think are likely to continue worsening for at least another 6 to 9 months from here. And that will impact company earnings, and that will impact balance sheets as well. Now, the positive news is we are seeing signs of inflationary pressures easing. So corporate inventories are rising faster than new orders. We're seeing less supply chain issues. Commodity prices are now some way off their highs from earlier this year. And we have started to see that show up in headline CPI numbers for the first time last month. So the CPI print for July came in below market expectations and was actually the first negative monthly reading since May 2020. So that's a really positive move in the right direction. And it does increase our confidence that inflation is past its peak, but we still think it's too early to declare victory in the fight against inflation. Policymakers are going to need at least a few months of confirmation before they start even thinking about pivoting their policy response to something much more accommodative. So for now, we're still expecting lots of volatility in treasury prices as the market tries to second guess the timing and the level of that last rate hike. And while the Fed continues with its hawkish rhetoric as well. So for now, as I said, still think it makes sense to be allocating cautiously in portfolios, at least for the next few months, particularly within return-seeking portfolios. And while I'm sure we'll get more rallies along the way, until we have a few months of meaningfully lower inflation, equity and credit markets are going to remain under quite a bit of pressure, particularly given that weakening economic story that's playing for the next 6 to 9 months as well. So thanks for watching. As always, if you have any questions, please don't hesitate to reach out, and we'll see you again next time.